Imagine two friends. Both have exactly $1,000. One friend invests that money into real estate. The other puts the same $1,000 into a simple index fund. They both wait. 5 years pass. 10 years pass. Then something surprising happens. One of them makes far more money than expected, and it's probably not the person you're thinking of. Most people believe real estate is the ultimate path to wealth. Others swear that index funds are the easiest way to become a millionaire. But if you only had $1,000 today, which choice would actually give you the better future? Let's find out. Every year, millions of people want to start investing. But they face the same question. Should I buy real estate or invest in the stock market? The internet is full of opinions. Real estate investors post videos showing luxury houses and passive income. Stock market investors talk about compounding and financial freedom. Both sides sound convincing. The problem is that most people compare these investments incorrectly. They compare a $300,000 house to a few $100s in stocks. That's not a fair comparison. Today, we're comparing something much simpler. What happens when you invest the same amount? Just $1,000. No tricks, no hype, just reality. Meet Jake and Sarah. Both are 25 years old. Both save $1,000. Jake believes real estate creates real wealth. Sarah believes in index funds. Jake spends weeks searching for opportunities. He discovers a real estate crowdfunding platform where investors can participate with small amounts of money. He invests his entire $1,000. Sarah takes a different path. She buys shares of a low-cost S&P 500 index fund. Then something interesting happens. Jake starts checking real estate news constantly. Interest rates, housing prices, rental markets, property values. He's emotionally attached to his investment. Sarah barely thinks about hers. She invests and moves on with life. Months pass. Then a market correction hits. The stock market falls. Sarah's investment drops. She feels nervous. For a moment, she considers selling. Jake feels confident. His real estate investment appears stable. He feels smarter. But fast forward several years. The story changes again. The stock market recovers, then grows even more. Meanwhile, Jake's returns are steady but slower. Neither investment was bad, but their emotional journeys were completely different, and that's where psychology enters the picture. Humans love things they can see. A house feels real, a building feels valuable, a piece of land feels permanent. That's why many people naturally trust real estate more. Psychologists call this the tangibility bias. We prefer physical assets because they feel safer, but feelings and reality aren't always the same. An index fund may look boring. You don't see buildings, you don't collect rent checks, you simply own tiny pieces of hundreds of companies. But boring investments often win because they remove emotion. Most investing mistakes happen because people panic. They buy when everyone is excited and sell when everyone is scared. Index funds encourage patience. And patience is one of the most powerful financial advantages a person can have. The biggest enemy of wealth isn't a bad investment, it's bad behavior. Now let's look at the numbers. Historically, the S&P 500 has returned around 10% annually before inflation over long periods. That means $1,000 invested and left untouched could potentially grow to around $17,000 after 30 years. Not because of magic, because of compounding. Every year, your gains begin generating their own gains. Real estate can also produce strong returns. Historically, US home prices have increased around 3% to 5% annually on average, depending on location and time period. However, real estate often becomes powerful because of leverage. People borrow money through mortgages. For example, a person might control a $200,000 property with only a fraction of that amount invested. That's where many real estate fortunes come from. But with only $1,000, leverage opportunities are limited. So when comparing pure investment growth, index funds often have an advantage. They also provide instant diversification. Instead of relying on one property or one neighborhood, you're invested in hundreds of major companies. Technology, healthcare, finance, consumer goods, everything. Let's compare. If $1,000 grows at 10% annually for 30 years, the investment becomes roughly $17,400. If $1,000 grows at 5% annually for 30 years, the investment becomes roughly $4,300. That's the incredible power of compounding. Even a few percentage points can create a massive difference over decades. Time matters more than most people realize. The earlier you start, the bigger the advantage becomes. Here's the truth. This isn't really a battle between real estate and index funds. The real battle is between action and procrastination. Most people spend years deciding. Successful investors spend years investing. The person who starts today usually beats the person who keeps waiting for the perfect opportunity. So, if you only have $1,000, an index fund is often the simplest, easiest, and most accessible choice. Real estate can create enormous wealth, but it usually shines when you have more capital and can use leverage effectively. In the end, the best investment isn't the one that sounds exciting, it's the one you actually stick with for decades. Because wealth isn't built by timing the market, it's built by time in the market. And that's what makes ordinary people financially free.